Hi everybody, this is first lecture for topic 6. The title of the topic is relevant cause for decision making. Okay, let's see. So you have learned about cause. I think in ACT3132 you have learned that there are many type of cause. Cause, I think one of the definition of cost is the amount that a business has to pay to produce something. Okay, so there are many type of costs. You have learned about manufacturing costs before. So there are three type of manufacturing costs: direct material cost, direct labor cost, and overhead cost. And then I think you have learned about another category of cost is manufacturing cost and non-manufacturing costs. And then you have learned about product cost and period cost. And then you have learned about fixed cost and variable cost, and also mixed cost. So another category of cost that you have to know is categories of cost related to decision making. So this is the one that you have to know. When you want to use or you want to learn about decision making, the one of the type of cost that you have to know is called relevant cost. So a relevant cost is a cost that differs between alternatives. Okay, so when you want to make a decision, you have to choose the best of several alternatives. In accounting, when we talk about decision making, it means that the process is like this. When you want to make a decision, the first thing that you have to do is to know what is the problem. The second thing is you have to list all the alternatives of solutions. And then the step 3 in the decision making process that we use in accounting is to use the best best solution for the problem. So the first step is identify or know the problem. Second step in the decision making process is to consider or list all the alternative of solutions for the problem. The third step is to choose the best solution for the problem. For example, you have a business. So at one time your business is having a problem. The problem is your business cannot produce sufficient number of product that can meet the customer demand. For example, every month the customer demand for your product is 10,000 unit, but now the problem is your business can produce only 8,000 units only. So that is one problem. So when there is a problem, you have to make decision. Okay, so step 1, you know the problem. So step 2 in the decision making process is you have to list or consider several alternatives of solution. So when you have this kind of problem, then the alternatives of solution that we can think of is, first, you can purchase new machine, for example. Second alternative of solution is you can hire more workers. The third alternative is you can ask your workers to do overtime. Solution number 4, you can outsource the production process to other businesses. So there are 4 alternative of solutions. Then the step 3 in the decision making process is to choose the best solution for your business. So you have to do some calculation to analyze which alternative of solution is the best. Okay, that is the thing that we do in accounting. So when you want to make the decision in accounting, you have to know which cost is relevant cost and which cost is not relevant. Okay, now next slide, this slide, identifying relevant costs. An avoidable cost can be eliminated in whole or in part by choosing one alternative over another. Avoidable costs are relevant costs. Unavoidable costs are irrelevant costs. Okay. So relevant cost is also called as avoidable cost. Avoidable cost means cost that can be cost that will disappear when you choose one alternative and you let go another alternative. That is called avoidable cost. Avoidable cost is a relevant cost. Or in another way, we can say that a relevant cost is a cost that will change when we choose one alternative and we let go another alternative. Okay, so and then another thing that you have to know is there are two categories of costs that are called irrelevant costs or costs that are not relevant in any decision. These two costs are sunk costs. Okay, sunk cost is something like this. Remember this. In the first half of this slide, you have learned about relevant costs. And the second half of this slide is about irrelevant costs, or costs that are not relevant, costs that should not be considered when you make business decision. Okay, irrelevant costs, there are two types. The first one is sunk cost. Sunk cost is a cost that a business has paid in the past and will not change, and will not change when the business want to make decision in the future. The example is like this. You have a business. 5 years ago, you have purchased a machine. You pay $5,000 for the machine 5 years ago. Today, you have the machine. You still have the machine today. And if you want to make decision whether to use the machine or to sell the machine or to modify the machine, the cost that you have paid 5,000 5 years ago is not relevant, because that cost will not change whether you sell the machine or you use the machine or you modify the machine. In the past you have paid $5,000. That amount of $5,000 will not change. Even any alternative or any decision that you will make, the cost is fixed. You already paid $5,000. So that is a sunk cost. Another example, like at the personal level, for example, let's say 3 years ago, you have purchased a motorcycle. You paid $6,000 for that motorcycle 3 years ago. So today, you still have the motorcycle. So if you want to make decision whether to sell the motorcycle or to use the motorcycle or to trade in the motorcycle with a new one, the cost that you have paid in the past, the $6,000 that you have paid in the past, is a sunk cost. Because today, when you want to make decision whether to sell the motorcycle or to use the motorcycle or to trade in the motorcycle, the cost, the $6,000 that you have paid in the past, will not change, and so that so this cost has no effect on the on your decision making process. Okay, and then the second type of or the second category of irrelevant cost is future costs that do not differ between the alternative. So let's say you want to you have a business, and then like I said earlier, you have a machine that you have purchased several years ago, and you paid $5,000 for the machine. So future costs that do not differ between the alternative is like this. Let's say every month you pay rental for your shop. Every month you pay $1,000 rental for your shop. So now you have a machine, and then you want to make a decision whether to sell the machine or to modify the machine or to use the machine. So the rental of the shop, 1,000, is an example of an irrelevant cost, because no matter what is your decision, the next month or and another and also in the future months, you still have to pay the same amount of rental. Okay, so that is an example of future costs that do not differ between alternative. So you will use this knowledge about relevant costs and irrelevant costs when you learn about the when you learn about the process of how to do the decision making. Okay, when you want to do the decision making, there are basically two steps in the process of doing the decision making process. Step 1, eliminate costs and benefits that do not differ between alternatives. Or in other words, step 1 is to eliminate irrelevant items or costs or benefits. Step 2, use the remaining costs and benefits that do differ between alternatives in making decision. The costs that remain are the differential or avoidable costs. Actually, this is not very difficult. You just have to remember the formula or the flow of the method. Different costs for different purpose. Okay, this one. Another one. Costs that are relevant in one decision situation may not be relevant in another context. So, in the previous slide, I have explained about the difference between variable. Okay, in the previous slide, I have explained about the difference between relevant costs and irrelevant costs. So you have to aware that when you do you have to aware that this situation can happen. Let's say at one time you want to do a decision making analysis, and this cost, let's say cost A, is relevant for that decision making analysis, and in another situation you want to do another decision making analysis. Cost A maybe is not relevant anymore. Like I said, for example, in the previous slide I have told you, let's say you have a machine and then you want to decide whether to use the machine or to sell the machine or to modify the machine. Then I told you the rental cost, for your shop is not relevant for that situation. Okay, that is one situation. But in another time, maybe you have to decide to make another decision. The decision is whether to continue to rent the shop or to purchase a new building or to renovate the shop that you already rented. Then in that situation, the rental cost $1,000 per month is relevant. The rental cost is relevant for one decision making process, but maybe it's not relevant in another decision making process. So you have to aware, sometimes this cost is relevant for this for one decision process only. In another situation, it is not relevant anymore. Okay, so this is an example. Let's see. Okay, this is an example, a simple example about how to make a decision. Okay, the management of a company is considering a new labor-saving machine that rents for $3,000 per year. Data about the company's annual sales and costs with and without the new machine follows. Okay, you can see here. Okay, you see here. The decision that has to be made is whether to rent a new machine or not. This company want to have two alternatives. Stay with the current production practice or rent a new machine. So how to make decision? To choose the best situation, whether to stay with the current production practice or rental or rent a new machine. So to make the decision, you have to compare. Like I said earlier, if you want to make a decision, you have to compare the alternatives and choose the best alternative. So let's see here. For the current situation, the sales is 200,000 and then the total variable expenses 120,000. And then the total fixed expenses is 62,000. So the net operating income or profit is 18,000. That is if for the current production practice. So now, the second alternative is to rent the machine. If the business rented this machine, the business can save labor cost. Okay, let's see. If the business rent this machine, the sales is 200,000. But the labor cost, you see the second item and in the variable expenses, the direct labor cost will decrease from 40,000 to 25,000. And then variable overhead is same, so total variable expenses becomes 105,000. But the fixed expenses will increase 3,000. So now, for the situation with new machine, the net operating income or profit is 30,000. Okay, so now after we do this analysis, then you can see clearly which decision is the best decision or which alternative is the best alternative. The best alternative is the second alternative, which is using the new machine or renting the new machine. If the business renting the new machine, the business will make $30,000 profit. With the current practice of production, it is only $18,000 profit. So see here. Okay, now you see the third column. Okay, the third column shows how to make the decision when you focus only on relevant costs only. See here, there are many costs. There are 3 variable costs, and also here there are 2 fixed costs. Okay, in real situation, the cost, there are many costs. There are many types of costs, but here they are like this. So if we focus only on the relevant costs, we will see that the calculation to, or the analysis to, for the decision making is very simple, simpler than if we consider all costs. So let's see here, the differential cost is only one item. If the business renting a new machine, then the differential cost or the relevant cost is only the direct labor cost. The direct labor cost, the difference is 15,000. Why 15,000? The cost will drop from 40,000 to 25,000. So the difference is 15,000. So the difference in the contribution margin is 15,000, and then the difference in the fixed cost is 3,000. The difference in total is 12,000. So if you look at this, one of the things that you can learn is, if you focus on the relevant or differential cost only, then the process of making decision is will become simpler. Okay, you will use this knowledge in the next slides. So this is the thing that I have explained. Total and differential cost. If you use total cost, you have to list to use 2 columns to list all the costs and see the difference in the net profit. But if you focus on the differential or relevant cost only, then the decision making process will become simpler. But you need to do some practice, because it's not easy to get the skill of finding the relevant cost only. So let's see. As you see, the only costs that differ between the alternatives are the direct labor cost savings and the increase in fixed rental cost. You can efficiently analyze the decision by looking at the different costs and revenues and arrive at the same solution. So if you know how to identify the relevant cost, then you can make the decision making process simpler and can be done quickly. Okay, so that the previous slides are the introduction for this topic. So now, see here. This is one of the decision making, one type of decision making that you have to know. This is called adding or dropping segments. So one of the most important decision managers make is whether to add or drop a business segment, such as a product or a store. Let's see how relevant costs should be used in this type of decision. Okay, you know that a management accountant works under a manager. So if you can remember, the thing that you have learned in ACT3131, a management accountant is a staff position. So a staff position is like this. The management accountant works under the manager, and the management accountant help the manager. If the manager wants to make a business decision, then the management accountant has to do the analysis and show the analysis to the manager so that the manager can make decision. So in this situation, the thing is like this. There is a business due to the declining popularity of digital watches. This business named Lowell Company's digital watch line has not reported a profit for several years. Lowell is considering dropping this product line. So the situation is like this. This business is a watchmaker, and then this business produces different types of watches. One of the watches that the business produce is digital watch. So now digital watch is not popular anymore, and the digital watch segment is making loss. So the manager of the business has to decide whether to continue the operation of this digital watch department or close the department. Okay, so let's see the data. So to make this kind of decision, you have to follow this decision rule. Lowell should drop the digital watch segment only if its profit will increase. This will only happen if the fixed cost saving exceed the loss of contribution margin. In accounting, when we want to make decision, the rule is very simple. If the benefit of doing something is greater than the cost, then we say yes. Then if the benefit of doing something is less than the cost, then we say no. So very simple. The basic that is the basic rule. So here, this is the basic rule for the adding or dropping segment. Okay, let's see the solution. Okay, this is the income statement for the department of digital watches. Sales is 500,000, and then variable manufacturing cost 120,000, variable shipping cost 5,000, commission 75,000, total variable cost is 200,000, contribution margin 300,000. So see there, the fixed expenses, there are 1, 2, 3, 4, 5, 6 fixed expenses. General factory overhead 60,000, salary of line managers 90,000, depreciation 50,000, advertising 100,000, rent, factory space 70,000, general admin expenses 30,000. So the total fixed cost is 400,000. So net loss is 100,000. You can see there, contribution margin is 300,000 minus fixed cost 400,000. So the business is making loss 100,000. Okay, this is additional information. Investigation has revealed that total fixed general factory overhead and general admin expenses will not be affected if the digital watch line is dropped. The fixed general factory overhead and general admin expenses assigned to this product will be reallocated to other product line. Okay, so see here, there are two costs that are not relevant, will not change even though no matter the business still continue production or close the production of digital watches. These two fixed costs are total fixed general factory overhead and general admin expenses. Okay, let's see how to make the decision. This one is another additional information. The equipment used to manufacture digital watches has no resale value or alternative use. So what happened if the machine or the equipment cannot be sold or has no resale value and has no alternative use? It means that the business has to keep the machine, and the depreciation will stay, will continue. The company still has to record the depreciation expense. Okay, now the question is, the business should continue the operation of the digital watches segment or to drop the or to close the digital watch segment or department. So how to make the decision? You use the decision rule that you have seen in the previous slide. So to make the decision, okay, this is the way to make the decision using contribution margin approach. If you use the contribution margin approach, then you compare the contribution margin, the loss in the contribution margin, and the fixed cost that cannot be avoided. Okay, the loss in the contribution margin is 300,000 because when the business stopped producing the digital watches, no sales and no variable cost. Okay, and then so that is the loss of contribution margin. But the saving in fixed costs only 260,000. Remember, I have told you that in the previous slide you have seen that there are three costs that cannot be eliminated. Variable cost, and then what else? Sorry, variable cost. The three costs that cannot be eliminated is total fixed general factory overhead and general admin expenses and the depreciation. So three fixed costs cannot be eliminated. Only three can be eliminated, and only three fixed costs can be eliminated. So the saving in contribution margin is 300,000. Sorry, the loss in contribution margin is 300,000. The loss is 300,000, but the saving is only 260,000. So this, if the business close the digital watch segment, then the business will have a net disadvantage of 40,000. Why net disadvantage? Because the business lost contribution margin more than it saves in the fixed cost. So 40,000 net disadvantage. So now the question, the business want to close the business supposed to close the digital watch segment or not? The answer is no. The business should not close the digital watch segment because the saving in fixed cost is less compared to the loss in contribution margin. It is a net disadvantage. This is one way to do this analysis. Another method is this one. Another method is called comparative income method or approach. Okay, so comparative income approach is you compare the profit or income before the closing and after the closing of the digital watch segment. So see here, If you compare the profit before and after the closing, then you will see this. See column 1. If the business or the company keep the production of digital watches, then the loss is 100,000. See the second column, the third column, sorry. The third column, if the business close the digital watch segment, if the business close the digital watch segment, then the loss is 140,000. So, if this is your business, which one is a good idea? To keep the production process or to close the production of the digital watches? The answer is the better idea is to keep the digital watches segment, because if this company keep the digital watches segment or to continue to produce the digital watches, the loss for this department or segment is 100,000 only. But if the business or the company close the segment, the digital watch segment, the total loss that the business has to pay is 140,000. So this shows two things. One thing that you can learn from this first decision making method is, one thing that you learn is, if you focus only on the relevant cost only or relevant data only, then the decision making process is simpler. We have seen the contribution margin approach in the previous slide. The way to make the decision is simple. The second thing is, if you use the comparative income approach, or you not focus on the avoidable cost, and then the decision making process become a bit complex, but the decision is same. You use these two methods, the decision is clear. It is better to continue the production of the digital watches. Better to continue the production. The number 2 lesson that you can see from this first decision method is, you have to aware that every time a business want to make a decision, the business has to do some analysis. If the business do not do the analysis, then the business will make a wrong decision. For example, here, if the business does not do the analysis, then the business will close the production of the digital watches. After doing the analysis, then the business know it is better to keep the production. Better to keep the production, because the loss is only 100,000. If the business close the segment, then the loss will become 140,000 more. It is more. The loss is more. Okay, this is the question. Why should we keep the digital watches segment when it's showing a $100,000 loss? Okay, why? The answer lies in the way we allocate the common fixed cost to our product. Okay, you will learn. I hope you have learned about this. When for segment reporting, there are two types of fixed costs. Common fixed cost, and another one we call it, what is the other one? Common fixed cost and like segmental fixed cost or something. But the most important thing is you have to know the common fixed cost. Common fixed cost means the fixed cost of a company that cannot be divided to the departments or segments in the company. If you divide the common fixed cost, then there will be a problem. it will not show the true performance of a segment. If you forget about this common fixed cost, then you have to read again the thing that you have learned in 3131. I think you have a topic called segmental reporting in ACT 3131. Okay, so this is the thing, and see here, our allocations can make a segment look less profitable than it really is. If you have a business, you divide the common fixed cost to different segments in your business, then there will be a problem, because when you allocate the common fixed cost to segments in the business, it will make a segment look less profitable than it really is. Okay, this is I will stop here for today's lecture. Do not forget to write your name and matric number in the comment section. Thank you very much.